Morning. Thank you so much for starting your day with ET Now. I'm Anisha Jain. With me is Nikunj Dalmia as well as Ajay Sharma in the studios. And of course, it's a good morning because the cues for the equity markets are looking good and the cues for us are also looking specifically very strong because of that big beat that we saw yesterday coming in at the Wankhede Stadium. Call it a beating, a thrashing, or simply a ruthless show by Team India as they dished out yet another very powerful performance. It was almost a 300-run win that we scored against Sri Lanka, completely one-sided. And of course, with this, India has managed to continue its winning streak. 7 matches in a row we have continued that winning, and of course it was the half century that came in from Virat Kohli and Shubman Gill. They missed their centuries by just 10 runs thereabouts, but Nikunj and me caught up right there at the Wankhede Stadium. What a vibe, what a completely different feel of
How
it,
was
right?
it? You guys enjoyed?
Yes, we missed you.
Oh well, I'm not much of a cricket buff, but there's a kind of a breakout which is happening as far as the Indian team is concerned. But Nikunj, what is the most interesting part of the match as per you? The people you caught up with around there, right?
It got over very early. I had different plans for the evening. Suddenly, we were hoping to stay back, and match actually got over in 20 overs. So the match got over very early. I mean, we only got 30 overs to cheer for India's bowling. We wanted to cheer for 50 overs for India's bowling.
So it ended before you even started.
Paisa vasool nahi hua.
Yeah, we were just joking that it felt like we were there for the highlights and not the full match because it was just wicket after wicket after wicket. So
I know it was very fast. In fact, not only the bowling, but even so it was a combo of bowling, very good bowling, and batsmen of course scoring very well.
Oh, well, yes, so that's the good news that we wanted to start the day with. But the good news does not end there because, of course, even if you look at the global markets, there's a big cheer. We saw that big monster rally on Dow, a 500-plus point rally, completely risk-on as far as the global appetite is concerned right now. The S&P was also doing quite well for itself. And, of course, all of these US indices are on track for their biggest weekly gain when it comes to 2023. It was the best session that Dow Jones clocked since the month of June. S&P also clocked one of its best months in many months. And of course, on the risk on side, you are seeing that the US 10-year yield that has come off very sharply from that 5% level. It's now down to sub 4.7%, and the CBOE VIX that also stands at multi-week low. That's below the 16 mark. Nikunj, would you say that convincingly now it seems like it's risk on and the risk off game is over?
Okay, now let's look at what has happened. Post the geopolitical tensions and after the US GDP data, the bond yields have shot up. The 10-year paper went to 5%, almost 5%, now it's 4.6. Brent, no, Brent cannot be in percentage, guys. Brent has to be an absolute number. Please take it out. So, apologies. The Brent actually is 96. 96 has moved to now levels of sub 90. Similarly, S&P from the recent low versus now, map at Dow, recent low versus now, markets are making a comeback. You can see visibility and you can see clarity. So the macro scare, which everyone thought, thankfully has not snowballed into a large sell-off. Historically, what we've seen is the last few, the seasonality which is at play in November and in December at play. Will that seasonality come back? Let's look at the YTD chart for the Dow and the S&P and the Nifty. The point I'm trying to make here is that given that bond yields have reversed, given that crude has retreated, given that dollar index now seems to be coming down, are we in for a last hurrah before the year ends? Historically, we've always seen the seasonality at play. So is worst of the macro print is behind us. The movement in the dollar index, the sharp spike in the crude, the uptick in the bond yield, the crack in global CBOE VIX. If all those factors have reversed, then do we have a clear line in sight for a year-end hurrah? I think it's point we should start thinking like that.
In fact, if you also club it up, Nikunj, that the numbers overall, there are no howlers actually coming in. Most of the numbers are either in line, slightly tilt towards the positive. That will also improve sentiment here in India.
So, Jay, no prizes for guessing that India is in a sweet spot. No prizes for guessing that, numbers were expected to be strong. The earnings season is good. it is reassuring. But the earnings season is not that grand that it'll warrant a big earnings upgrade. So what you need to understand is that the earnings season is simply endorsing what the broader tone of the economy is and what the broader assessment is. The trick now is that where will the fillip for the market come from? And will the fillip from the market come from local cues? I doubt it very much, because you don't have too many large global cues which will generate upside momentum. So it has to be global cues. What could come from global markets? Well, we've already seen a retreat. We've seen that seasonality tends to kick in the month of December. And I doubt that if you've seen this kind of a sharpest reversal in most of the risk on indicators, then we actually are unlikely to see any deterioration. So the case I'm trying to make here is that are we in, I'll say it again, are we in for a last hurrah, courtesy what has happened in the global market? We've been hunting for this trigger. But is it time to start thinking on those lines? Is it time to start saying, okay, I'm going to start going long again. I'm going to be, aligning my portfolio for a global push. Because if globally things come back, which they are coming back, and history has told us that November and December, and especially the month of December always tends to be the seasonality at play. Yeah, so are we in for that seasonality? Because data seems to be indicating that rally aane wali hai.
That's a very important point. In fact, yesterday we were discussing in the REIT meet that in the last 10 years, there have been, in fact, out of the last 11 years, 10 years, we've seen November ending on the positive.
Historically, you always see seasonality.
Yeah.
The case for the seasonality is always made when you see movement in dollar index, global VIX, crude, and which way flows are moving, and yields. All those factors have suddenly reversed. So I'm just saying it again. Sorry, I'm sounding like a parrot today, but I'm just getting this thought, and I'm getting this, purely if I've poured in my years and years of, experience as a market commentator. I think you could just brace yourselves for maybe some global infused rally now.
Global infused rally, yes, and you're forgetting the domestic factor of elections, and 6 months ahead of elections we see that rally also coming through. So looks like that stars are aligning, whether you call it the global arena or the domestic factors as well. But pretty much just wanted to highlight that for last week, India has been a bit of an underperformer actually. If you look at NASDAQ, that's actually managed to gain 4%, whereas Nifty has been flat. S&P 2 managed to gain 3.7%. So there is that kind of, room probably available for us to catch up as well. And that catch-up support can also be coming in from the earnings as well as, Ajay was pointing out. While Tata Motors also was on the number side, not as strong a number coming in this quarter. But of course, the big question is the commentary, and that is what has come in strong. So this time the revenue was pretty much in line with expectation with a 32% growth. The EBITDA actually came in line with expectation. Margins were, however, slightly lower, and that's the reason the profitability was a smidge lower versus our expectation. It came in around 3,700 odd crores. But the commentary again is very important. They are aiming to deliver a stronger performance in the second half of the year. The guidance of JLR EBIT margin has been now increased to 8% versus 6%, and even in terms of the net debt, they are likely to reduce as less than to £1 billion by FY24, and that too is an important factor. Nikunj, Tata Motors of course has run up on all of these cues as well. While of course there's an upgrade in guidance, it's not completely new news. We know there is a restructuring and an improvement underway. What do you think it will do for the stock prices from here on?
See, Tata Motor already has seen multiple triggers which have played out from where the stock was versus where the stock right now is. I guess, first markets were confused about the China factor and the JLR business. But the reverse has happened. Operating leverage benefits have kicked in. JLR margins which had plummeted, they are now marching towards 8%. The domestic EV space, I think they are clearly moving, really in the right direction. What really could be the trigger? Well, if you're talking about the near term, it may not be a trigger, but the near-term narrative, it would be listing of Tata Technologies, which is subsidiary of Tata Motors. Let's see how that progresses. B, they've lost market share in the CV business. Are they likely to regain it back? And C, are they, the markets have got much more than what they ever actually thought they will get from the management of Tata Motors. Big turnaround in Tata Motors, delisting of the Tata Motor DVR, and then Tata Technology IPOs. So the sequence of events in last 12 months for Tata Motors really they've delighted and surprised everybody. That sequence of event is unlikely to continue. So then what happens next? Well, a little bit of adjustment because of Tata Technology IPOs, and then markets would look at incremental earnings now to really make a view. I think at 600 plus, Tata Motors, in my book, I think it's fairly priced. The P expansion has happened. The re-rating, which has been the Jacob effect for Tata Motors, it's been the stock of the year, that already has happened. But now I think it would be a function of how things would move on the earnings front and what exactly is the progress for Tata Motors, even on the EV business. From JLR, I think the attention will come to EV.
In fact, Nikunj, the first deal which happened with the PE players for the EV business, there's another one which was in the works, and the widespread expectation was that it will happen at 10, 15, 20% premium to the previous deal. That deal hasn't come so far. So that is something also, one of the monitorables.
See, we were very clear at the beginning of the year that Tata Motors will be stock of the year. So it has actually translated the way we thought.
Yes.
And let's look at the sequence of events. I'm just going to say it again. At the beginning of the year, nobody expected that they will take Tata Technologies public. Nobody expected that the JLR turnaround would be so solid and so strong. And nobody actually thought that they would even consider a DVR buyback. They've done the following, and the stock's gone up. Now, what else can they do? I don't think in terms of a corporate announcement you're going to get too much now. So Tata Technology is incremental because of sum of part. So now for Tata Motors, what would move the needle? Well, it really has to be how the earnings progress. And if they come out, let's say 2 quarters ahead and say that we are preponing a net get guidance, if they do it, then markets will say thank you.
Which they have been talking about in the last 2-3 months.
But they've not made it official, but the numbers indicate that they should do it.
60% on a YTD basis. In January, I remember you were clearly making the point that Tata Motors could become, and it's only, we are in November, 10 months. 60% in 10 months is not bad. But let's take it forward and talk about, get you a flavor of what kind of commentary is coming from the global biggies this morning. Vinny has taken stock of that and is joining us now. Vinny, tell us.
Good morning, and absolutely firstly we'll start with a bit of a different commentary today that is coming in from the Swiss National Bank President Thomas Jordan, and this one is on the real estate prices in Switzerland. Now specifically highlighting that we are seeing a drop, they are expecting to see a drop in the prices because the real estate prices are quite overvalued, so keeping an eye out on that one. Moving on, we also have commentary that is coming from ECB in terms of the fight against inflation. They are saying that they may require to increase the interest rate again, and this is the commentary coming in from Isabel, the executive board member at ECB. So yes, a possibility that we could see an increase coming in given that there are renewed supply side shocks is what is highlighted by Isabel. Other than that, threatening medium term price stability, which is a concern. So because of that, expected to see that more rate hike could come in from ECB as well. And on that, let's also pick up the commentary that has come in terms from Apple earnings, because Apple reported their numbers, and this time when you see that mainly the company highlighted that there's a drop in China's revenue, and Mac sales are something that missed the estimate as well. Also, they're warning about, China already has seen a decline, but holiday season, maybe that could be muted as well. So that's a bit of a worry that one could see and keep an eye out on in terms of global commentary that comes in from company and Apple's earnings, especially going forward as well. Other than that, we have commentary that has come in from BOE's Bailey, who is highlighting in terms of they expect inflation to actually fall this year as well as next year. They said there's no room for complacency and they're watching out for further rate hikes if that is needed. So keeping an eye out on that, because right now they see inflation just below 5% in October, and there's an upside risk to inflation from the Mid-East conflict as well that is going on. So concerns still around those inflation is going on. Other than that, lastly, commentary is from ECB's Nigel, who's highlighting Germany isn't the sick man of Europe, and inflation is slowing and showing that policy is actually working over there as well. Still, some points away, some distance away from the 2% goal that they have, but at least they're moving in the right direction. That's the word coming in from him as well.
A comprehensive wrap of what is the major commentary coming in from US, from European markets, and of course how the Apple earnings have really shaped up. But let's decode all of that with Jeff Dennis as well. He's joining us to talk to us about his, his understanding of the global market setup right now. Jeff, the kind of data that we're looking at right now does suggest that the risk-off phase is over, and there's pretty much a monster rally underway when it comes to the equity stock markets. Your take?
Yes, it's been a huge week for equities. I think we've got to keep it in perspective. I think there's a number of things which have gone on which have driven it. First of all, of course, the Fed Chair Powell was, if anything, giving us a bit of a dovish hold, if you like, on interest rates. We had a weak ISM for October, which may suggest that we're heading towards a slower US economy at the margin, which will increase the hopes for a soft landing and reducing some of the very, very strong economic data we've had recently. And all of that is combined with a very, very big rally in the bond market. So it's been a very, very nice cocktail we've had here for higher markets. But there's a number of question marks you can still pose about all of this. And in particular, what I'd be concerned about is I don't know how much bond yields will actually fall, because of course we're still facing enormous budget deficits in the US, which do need to be financed. So things are moving in the right direction at the moment, but there's still plenty of challenges, I think, facing the markets over the next few months.
We also saw not only the global VIX falling to 3-week lows yesterday, but we are also observing that it is all happening in synchronized manner. Yields coming off, dollar index falling, we are seeing VIX falling, and we are also yesterday, in fact, overnight, the probability of a rate hike by Fed in December fell to almost 14%. Well, how are you thinking? What is all making it a good cocktail for equities in the medium term?
Yes, I mean, I think it's very hard to call December, frankly, and I understand why, following what Powell said, why the markets want to be pretty bullish that there won't be a rate hike. But as you will know, and your listeners will know, we've got 2 CPI reports and 2 employment reports before the Fed meets again. So there's plenty of things that could go wrong with that scenario. My point I always make here is that we are either at the peak or we're very, very close to the peak. I happen to believe that we are at the peak now, but if we're not, we're a quarter of a point away from that. And I think what Powell was saying after the meeting on Wednesday is kind of consistent with that. In other words, he's really saying, we may not have to do much more tightening. And so that's all good news. And I don't deny it's all good news. My point is that I think the bond market rally is a result in part of a slightly better refinancing schedule than expected from the US government, and partly because of what Chair Powell said. But at the end of the day, you do need, I think, going forward, a further strong rally in bonds, 50, 75 basis points off where they are now, to really drive these equity markets, say, 15, 20% higher. And I worry a little bit about the supply side of the equation here. But there's no doubt at all, it was a great mix this week. You mentioned the weaker dollar. That's a key part of it. And of course, within all of that, emerging markets came off the bottom as well.
All right, Jeff, thanks so much for taking time out talking to us about the global setup for equities. Let's move on and focus on Indian markets and levels to watch out for. Vaishali Parekh is joining us along with Nooresh. Vaishali, morning. Nooresh, to you as well. Let me start with you, Vaishali. We have rebound very sharply from the Thursday panic, and it appears that another gap up is in the offing today. How would you recommend trading for those who are already holding their long position and also who are wanting to but are not getting a chance?
Very good morning. And first of all, thank you for having me on the show. But yes, it is showing a very positive move, because we saw time and again 19,000 was held on, and today we are seeing that we would have a good opening. So technically I would say 19,250 is holding on as a crucial resistance level on spot basis. So the minute we see Nifty surging above that, it would give a good bounce back rally from there on. So I would say, yes, it is become a buy in decline. Keeping in mind, now I would elevate the support levels of 19,000. So that would be my view in Nifty. And likewise, we've seen even in Bank Nifty, 42 was a very prominent support level and which was respected. So now I would, even in Bank Nifty, I would elevate the support to 42,500 and the near-term resistance lies at 43,500. A move above that, we would be looking at a good strong bounce coming from Bank Nifty as well.
But, Nooresh, wanted to get your sense. While yesterday we did try to break out of the, range and we went above almost towards that 19,200 mark. But by the end of the trading session, there was again a cool off. And we again managed to stay in that, 19,850, the level of around 18,950 to 19,150 range. Do you see us breaking out of that range today?
So again, today could be a test of that 19,250, 19,300 mark. But looks tough that we sustain about 19,300 today as such. We'll just go and test maybe a few points higher than that. But structurally, the difference is very clear that the index continues to sulk because of the heavyweights. If you look at the recovery on the mid cap index, the small cap index, you've flipped back above a similar swing low resistance. So you have the small cap, the Nifty small cap 100 just 3% away from an all-time high, has made a strong recovery yesterday. Same is the case with the mid cap index. So overall, if you look at even a lot of indices, say the Nifty Auto Index did not even break the 50-day moving average. The CPSE did not. Even a lot of broader market indices have not done so. So till the time we don't see heavyweights recover sharply, something like a Reliance, HDFC, ICICI, we are going to find a problem around 19,300, 350, but there could be stock-specific action. After the global recovery yesterday, the stock-specific action could get better is the view.
Okay. Stock-specific action could better. So Nooresh, I go back to that same point. We are at that point which really matters in terms of the resistance. We are at that global turn which is important. Dollar is down or dollar index is down. Crude is down and VIX is down. Are we in for a last hurrah for 2023? Are we in for a rally which will start before Diwali and could extend till Christmas? I mean, it may start with Happy Diwali and it could well be a Merry Christmas.
So looks like we are setting up for the same because the way we've recovered in the few sessions globally was more than expected. And also the fact that the breadth is good. What it implies is all we need is one or two heavyweights to do that. But if you look at stock-specific action, say I would be looking at a possible case for mid-cap and small caps to continue to do better. And once we see at least one of the heavyweights take leadership, something like a Reliance, ICICI or HDFC, we could actually go back to 19,800, 20,000 also. So for now, 19,000 for me becomes a base. And as we sustain 19,300, the case for a year-end rally keeps on increasing.
About specific trading ideas then, Vaishali, what are the stocks on your radar this morning?
So, well, to start with, I'm choosing stocks which have long-term trend intact and which has retraced to quite an extent. So, one of them would be Tata Power. Yesterday, we saw, it has a good support at now on the near-term basis at 220. But for a trading strategy, I would recommend Tata Power as one of the stocks because I'm looking at a positional trade for a target of 252. And of course, for a longer period would be much higher. So, Tata Power at the current scenario. Then the second one I would look at is SAIL. So metal pack on the whole, of course, we saw good pickup coming in Hindalco, non-ferrous began the rally. But I think SAIL also technically is very well placed right now. With a stop loss of 83, I would look at a trading strategy of 89. Now, the third one, which I would look at is actually even cement is showing a good move like Ultratech to start with. So I would lay my bets on India Cements because good corrective move occurred. And with a stop loss of 203, I would now look at 220. So these would be my trading strategies for now.
So those are the top recommendations coming in from Vaishali. SAIL and India Cements is something she likes. What about you, Nooresh?
The first stock is a buy on auto stock Maruti. And overall, the whole auto index per se, most of the auto names have relatively outperformed and are making multi-year breakouts in some cases like Maruti. So Maruti is above the 10,000 mark, which was the high back in 2017-18 and also for the last couple of years. So a big cup and handle breakout here. The retest right now is a good opportunity. A risk reward trade here, stop loss at 10,000, a short-term target price of 11,200. Second is a buy on GAIL India, which has seen a correction from 130, 33 odd levels back to 118, the last breakout point. Has seen a reversal in the last three sessions. Seems like a march back again towards 135 levels, a stop loss at 118.
Okay, point taken. Thanks so much, Nooresh, for that. Hang on, we'll come back to you. But we right now have Somit also in the studio to talk to us about what are the stocks that you need to have on your radar. Let's start with the ones which are going to report their earnings today. Indigo as well as Zomato on the radar. So let's start with Indigo. We were expecting that the last quarter was perhaps the best and from there it's going to be downhill. Is that what we should expect?
Well, yes, if you see the common theme between both the numbers, that is Zomato and Indigo, is the fact that the commentary for Q3 is something that the street will be watching out for. For Q2, for Indigo, when it comes to Indigo street, already knows that it's not expected to be a good quarter from supernormal profits of 3,000 plus 3,000 more than 3,000 crore of profits in Q1. The company is expected to report a loss, and this clearly shows the inconsistency in profits when it comes to the airline companies. And if you see, the loss number is expected to come in at close to 660 odd crore rupees. Now Q2 is seasonally weak, because of which there was lower air traffic, lower passenger load factors and lower yields, which measure the average fare per passenger per kilometer. Now average ticket prices on a sequential basis were down nearly 13%. Average daily air traffic on the domestic side was down close to 5%, while the passenger load factors, which is a measure of capacity utilization, that dropped by nearly 600 basis points. Now in the second quarter, to gain or to protect its market share, Indigo came up with multiple offers, and that could also weigh down on the company's profitability in the second quarter of FY24. But the key thing to watch out for from Indigo results or management commentary post the earnings would be their FY25 capacity guidance, the Pratt and Whitney engine issues, how they are dealing with it, what is the additional cost that they are getting because of wet leases, and what is their outlook or what is the kind of demand that they're seeing when it comes to the festive season. And when it comes to Zomato, the numbers, if you see, they're expected to grow around 8%. There's a revenue number. Adjusted EBITDA is expected to come in at close to 60 odd crore rupees from 12 crore what the company reported previous quarter. But what the street wants to know is some qualitative details when it comes to Q3. What is the kind of growth that they are expecting? What is the kind of growth that they have seen so far? And what is their profitability outlook when it comes to Blinkit?
Okay, but Nikunj, what about your take? I mean, Zomato, of course, we were all expecting that when it comes to the festivities and World Cup, Q3 is going to be the bumper one, but the turnaround of Blinkit, the commentary about turning profitable, that's the thing to watch out for, right?
Okay, January, what was the narrative for Zomato? Will they ever make money? November, what is the narrative for Zomato? How much money they will make? So please understand the narrative has changed. But the stock has gone from 50 rupees to 100 rupees. So the change in narrative is something which is also getting captured. Zomato's market cap is now nearing about 80 lakh crore. 80,000 crore, sorry, I beg your pardon. 80,000 crore. 80,000 crore makes it almost a $10 billion company. At $10 billion, now markets would say, okay, what's next? So for Zomato to sustain, and it's a stock which also is dominated by HNI investors, it's a stock which is dominated by a lot of large positional HNI investors. They've got spoilt in last 2 quarters because of the surprise and because of the quantum of the surprise. So minor, I mean, what Samit just referred to, the numbers, if numbers are pretty much in line with what they did last quarter of 5 crore here and there, I don't think markets will get excited. It may actually be in the short term a stock you want to sell in the short term. But for the stock to sustain and let's say move to 115 or 120 or 125, you need a big surprise. Could that come from Blinkit? Could that come from the forward commentary? So that I think would be the real monitorable for me, which will excite the stock. My view is very simple, that Zomato is in a oligopoly business. It's in a high growth business. Capital allocation has changed. They're doing all the right things which will give them operating leverage and financial leverage, whether it is turnaround of the food delivery business or Blinkit acquisition or some of the listings like Yourfit and Shiprocket. So 3 year hence, I think Zomato should be part of everyone's portfolio. But since we're talking about this today and tomorrow, you need a massive surprise from Zomato for the stock to get excited. For Indigo, a mild surprise could get the stock excited. And the mild surprise could be a function of yields. It could be a function of, how efficiency has kicked in. So 2 different companies, 2 different expectations. Indigo, mild surprise could do a trick. A mild surprise from Zomato is disappointing. It may not really steer the stock higher. So Zomato, we need a big surprise from you. Indigo, a mild surprise will make the stock gain.
For Indigo, even the valuations are in favor. For the $10-12 billion which they are trading at, they do already $1 billion profit, almost there.
See, I will not be surprised that in 3 years from now, we actually will be talking about Indigo as a consumer company. We are still calling it this as an aviation company, but there are, which are the sectors in India where you can be reasonably confident of a 15 to 20% growth? Which are the businesses which are consumer facing, and you keep the crude volatility aside, that is something which nobody can measure. But I think we are in for a stable policy regime. We are in for a regime where there is going to be no war. We are in for a regime that there will only be 2 players. SpiceJet will always be a minority. Go Air is not going to be having a large mark. Their fleet capacity actually would double somewhere in the next 5 years.
Yes,
they are
that's
adding
what they're
international
aiming at.
capacity. Pricing power and discipline has come back, and they have a lion market share. So I think the scenario for Indian aviation sector is rather, it's not bumpy. it is actually in that cruise landing mode. So I think if I have to talk about the terminology in aviation terminology, I think it is in a very sweet spot.
No turbulence as such, completely under the control. That's the way to look at Indigo's trajectory right now.
Yeah, Anisha, autopilot, like the pilot can put the plane on autopilot and relax. I think Indigo and the aviation sector is in autopilot mode.
So you can invest the money and think that it's on autopilot and it will compound on its own. You don't have to worry about any turbulence as far as compounding is concerned. But what about the latest commentary coming in from Chris Wood? In his latest Greed and Fear note, he's talking about the banking sector. He says that it's been underperforming a bit because of the overall reduction, overall over ownership that we have seen, Somit. But then there's still room for some more ownership from the retail side now.
In fact, it's not the retail. They are saying that there are a lot of global funds. Now, what we are seeing an over ownership or overweight on banks is from emerging market funds that are invested in India. But he's saying that the global funds that are still not invested in banks, and that investment could come in going forward because they are still not. They have stopped investing directly in China. So the money that they have could now come in India, and bank would be one of the most preferred picks for these global funds. Now, from November 2020 till now, if you see the PSU banks have in fact outperformed the private banks by nearly 153%, and this could reverse going forward as per Chris Wood. Now, a few other factors that are in favor when it comes to private banks is the valuations that they are cheap. Also, given the fact that the earnings that they have been reporting have been strong and not a disappointing set of numbers. So earnings are in favor, valuations are cheap. It's just that the funds or the money needs to start flowing into private banks. That's what Chris Wood is suggesting.
Because in fact, this point which Chris is making, that global funds are barely invested in India. In fact, even EPFR was saying that whatever FI is selling, actually you're seeing it because the basket selling is happening. In fact, India dedicated are yet to come in a full manner.
See, you look at MSCI benchmark. The MSCI benchmark is highest in China. I think it's more than 20%. Now, 20% of your benchmark is in a country which has underperformed. And even if you maintain normal rating there, the MSCI China dedicated funds are massively underperforming. So that I think is something which will start bothering, and it has already started bothering a lot of money allocators. Now you may call it compulsion, you may call it you may call it pure redemption or risk aversion in emerging market funds. In India, the positioning data, what we were looking at it, FI FNO, it is at a multi-year low. FI long, it is nowhere close to its actually closer,
coming down.
It's coming down. It's close. It's nearing its historical low rather than historic peak.
True.
So in terms of commitment levels, I think it's just not there, and that's a point which I think we are trying to bring out in the morning. That from Happy Diwali to Merry Christmas, if we have to say this line again, are the ingredients in the melting pot there which will ensure that we will have a strong rally? The answer to that is well, yes.
Okay,
the ingredients are getting ready and the cake is going to be baked before Christmas. I'm very confident now.
The cake will be baked before Christmas. Happy Diwali. You should get all your crackers ready. And we'll discuss some of the cracker stocks with Sanjeev Haseen on the other side, waiting patiently. We'll come back after this very short break. Right, Sanjeev Haseen is joining us now. Sanjeev, good morning. What a rebound from the Thursday panic lows. I was just looking at the index. Forget the index, the small cap index. That has rebounded almost 6.5% from the Thursday's panic lows. And I clearly remember you were the one calling out that this fall should be bought. We are going to have a cracker of the Diwali. I won't hold you on levels, but at least the good rebound has indeed played out. How are you looking at things now?
Good morning, Ajay. Well put. And we've just started. Look at the US markets. It's on a roll. Bond yields from 4.95 are down to 4.65 and looking good for more. Dollar is weak. China is rebounding. And why are we sulking? So I think it's the index now. And like you rightly put it out, on any fall, REC, PFC, BHEL make new highs. So I am of the opinion that we are just passing time and consolidation, which is very healthy for the market. But the real action will start from maybe today. I think that we are headed to 19,700, 20,000. Fingers crossed, maybe 20,000 by Diwali. The ascent of the fall was more to do with a lot of factors accumulated. And now the rise will also come in sync with that. You cannot have mid caps make new highs and the index do nothing. And now the valuations are playing catch up. Whether you look at banks, how long can HDFC Bank underperform? ICICI Axis numbers have been far ahead of the street. PSU banks have taken the market by storm. So I think it's going to be metals, banks, and construction and autos which will drive the market higher. So cheers to a new sparkling Diwali which comes next week. I am very, very bullish on the market.
Very bullish on the market and very ready with that sparkling Diwali, and we'll get more Diwali ideas from you, Mr. Bhasin. But in the meantime, let's listen into the commentary coming in from the management of Godrej Properties, because it was a very good set of numbers. But more importantly, the details that came in from the presentation with respect to their bookings and pre-sales is something that really impressed the street. Listen in.
Yes, I think we've been extremely happy and delighted to see the kind of traction all of our new launches have received over the past several months. We've had a project launch in Noida, which was our best ever project launch with over 2,000 crore of sales during the quarter. We had a plotted development in a new market for us in Kurukshetra, which was our best ever plotted sales launch, where we sold over 600 crore of inventory. We had a launch in Bangalore where we've seen over 500 crore of sales. So I think where our general sense is the projects that we are bringing to market are seeing a robust demand. And the whole goal for the second half is to ensure we maximize the number of new launches. We have several projects in the pipeline that we're quite excited about. Probably the biggest of these is a project we have in Delhi, in Ashok Vihar, which we hope to launch in the second half. We also have a new phase of our Vikhroli development that we intend to launch during this period. Several other new projects that we've recently added in Gurgaon, Pune, Bangalore, and Mumbai. So I think the calendar of launches is quite full. And I think the ultimate determinant now will be how many of these projects we're able to ensure receive the required regulatory approvals in time to be launched, both in the third and fourth quarter. But we expect a fairly robust second half to the year. And if we look at it, generally speaking, in almost all of the last few financial years, the second half has disproportionately contributed to the full year booking value of the company.
All right, so that was a slice of the conversation. We'll bring the entire one. A good response continues for quality marquee players. And it's not only Mumbai or MMR volumes, NCR volumes are also witnessing pretty robust movement. So we'll get you the entire chat around 10 o'clock, but Sanjeev is here. Sanjeev, Godrej Properties has been one of your stocks. I remember when it fell from what? If you could pull up the last 1 year or 2 year chart, from peaking out around 2,500, it fell to what, 900 or 1,200 or thereabout. There was a lot of panic on the street. You had, I remember, started talking about it around those levels, around 1,200. Now it's 1,700. Are you still bullish on this one or some other similar property stocks?
Yes, Ajay, you have a very good memory and you're right. Actually, I own Godrej from 350, 400 in the last 5 years, and it's a personal as a disclosure. And I believed in the management. I believed in the outlook. I believed in the pedigree. You can yourself see, smell the coffee at 11, 1,200. The second largest player in the country was available at the weakest valuation. And now, you are just raring to go. DLF numbers, Godrej numbers, plus the effect of wealth is humongous. If you just saw close to where I stay is Camellias, DLF sold a 10,000 square feet a house for almost 100 crore. Maybe 100 crore is an aberration, but still 70, 75 is the rate. So real estate is taking the market by storm in the sense fixed assets are doing well. And pedigree players, Ajay, it is always going to be pedigree players who will lead the pack, because people have had enough of errant builders who have taken the money and not performed. Godrej has been an outperformer along with DLF, and just to tell you, they're hitting new highs at a time when the index is doing nothing, which is telling you that where these stocks can go if the index starts to go to new highs.
What about Tata Motors? I mean, there is a view that Tata Motors, in fact, we've been positive about it, about the development which could be there in the offering from January onwards. Nikunj even called it possible stock of the year. 60% YTD. Numbers are good. Numbers are overall in the good direction, and margin guidance is towards the positive. But the second deal of the EV business, which market was expecting so far, probably a 20% premium to the previous one, hasn't happened. Do you think positives are priced in, or even at these levels you are okay with the Tata Motors?
So Ajay, there are three parts of the pie. One, the stock has run up fairly strongly from 390, 400 levels where we were very bullish. A. B. A large part of the earnings will get into the prices. But three, look at the business model of both Mahindra and Tata Motors. The EV market in Nexon is only gathering steam. China seems to be on a very, very strong comeback, which is why I think metals and autos, particularly JR, will do very well there. And you know, the spread of other products which they have are actually expanding, and that includes Europe and the other markets. So I think their global portfolio is good. Locally, we are in the sweeter spot. You've seen auto lenders, you've seen auto stockists, and everyone ride their way along with the OEM chain. So Tata Motor is a must-have in a portfolio, whether you buy some now or lower. I am looking at a target closer to 800, which can come, before the budget. I also think Bajaj Auto, Hero Moto can be really the stars of 2024, given that they're coming on a low base and rural incomes have started to pick up. But Tata Motor is a must buy on now and on any decline.
Tata Motors is a must buy right now or in any decline. But Mr. Bhasin, what's your take on Zomato? The stock will come out with its earnings. Anything that we should specifically watch out for?
Well, the real icing may have taken place from 50 to 100, the run-up, but I still think it's got miles to go. As a disclosure, we own this stock in our portfolio, which has been a contrarian play and played out excellently. We think Paytm, Zomato and PB Fintech are here for the next many, many years. Like you pointed out, Anisha, numbers will have to justify the valuation. It's not a cheap stock and earnings will take time to come, but you can't track this stock or this fintech business on a monthly or a quarterly basis. You have to give them more time. As you are aware that their margin expansion and their reach is getting bigger. And I think that the eating habits or the QSR space is very, very attractive. As a disclosure, we have a buy on this stock. We own it. This, Paytm, PB Fintech and Devyani International are four of our top picks.
Okay. I'll just like to go back to the railways and the defense stocks. And Sanjeev, is the zing out? Is our best of the gains for the year in some of the railway stocks, is that over?
Well, I was, Nikunj, just seeing the presentation of Jindal Steel and market was disappointed in numbers. I was also not aware. The biggest supplier of head-hardened rails is Jindal Steel in the country. And they are talking of metros in Ahmedabad, Surat, Chennai, Indore, you name the city. And they are saying their order book is the strongest ever in the history of the company. So I think that railway stocks, metro stocks, the ancillaries have miles to go. Yes, they have run up a lot, but I am extremely bullish. And I would advise investors, if you have the option, take a stock, look at this Jindal Steel, JSW Steel. Steel is going to be the real killer in the next few months. We have these issues of Ukraine and now spreading to Israel. Sooner rather than later, commodities will pick up. China is on the rare comeback. But in India, the consumption, particularly railway and defense, will mean that conduit players who are input costs will do very, very well. So you just see the presentation of Jindal Steel and JSW, you'll be amazed. I am extremely bullish on certain names in the railways, and I think that there is still much more upside. IRFC is one of the preferred picks. I think numbers are very strong. It has no debt, and it actually gets yields at the highest, and its cost of money may be the lowest in the PSU pack.
Sanjeev, did you manage to catch the results for Kirloskar Oil Engines? This is the second or third result they've posted after that analyst meet, the first one they had in 10 years, and numbers are appear to be falling in place.
No, Ajay, I've not had a look, but we've had a coverage on this stock much lower. The stock has been on a zoom, and that's more to do with the Kirloskar Group's re-rating in a lot of sectors, particularly the brand ownership of Toyota, which they have here on the franchise. But like you said, Kirloskar is an under-owned group. Kirloskar Pneumatic is one stock we own. I have not had a look at Kirloskar Oil.
As far as the numbers are concerned, last couple of quarters, but oil engines will be in focus. Results have been good, and that's the management. Gauri Kirloskar would be joining us later in the show. Take a short break, come back with Sandeep Sabharwal on the other side to discuss his view and stocks he's putting on his radar right now.
Well, last Friday I said TGIF, thank God it's Friday. Today I think I'll have to say why it's Friday. Because global markets have come back, risk seems to be reversing, crude is down, and dollar index is also favorable. Let's look at the construct there, please, once again. And I'm going to go to Sandeep Sabharwal for his views. That's the Nifty for you this year. But what is important for me is that 4.6, 4.9 or 5 on 10 year has become 4.6. 96 on Brent has become 86. 96 has become 86. $10 gir gaya hai. Brent is also, 10 year is also down from 5 to 4.6. So 5 seems to be the top end at which at which the 10 year paper seems to be retreating. And the dollar index has also started marching lower. 107 has become 106. Now let's look at Nifty. In the series, which is from last Thursday to this year, I'm talking about this series. Nifty is today likely to open ahead above its series high, which means that there could be an element of short covering. FI positioning in the FNO market is already very short. So just when everybody thought, okay, it's going to be geopolitical concerns, FI selling, no earnings trigger, are we in for that last hurrah in the market? And Sandeep Sabharwal, good morning. Thank you for joining us. The global markets are favorable now. So are we in for that hurrah now? It may start now, which starts with Happy Diwali and then it goes to become a Merry Christmas.
Yeah, it's possible and very much likely because global positioning on equities as well as risk assets is now at extreme pessimism. So all of us tend to look at the Indian markets without correlating to other overseas markets. So actually, if we see in the global market, there has been significant corrections both in the US, European, as well as other emerging markets. So India held up, and there are several reasons for that. One is strong domestic flow. Secondly, the macros in India are much better than most of the economies, etc. And to that extent, our rallies might also be less sharper, but then that's fine because very sharp rallies in any case I don't like because things tend to move up very fast. So 2024 overall I think will be good for equities.
One read into this reversal which has happened in the 10-year paper, crude, global volatility. I mean, the decks have suddenly, or the table suddenly has changed. Setting on the table has reversed in 1 week. Sandeep?
It was imminent because on crude also, on crude, people track crude prices. I think the key things to track are refining margins. So the way refining margins were collapsing, it was very apparent that final product demand was very low and crude holding up at these levels was not possible. And this is despite the tensions in Middle East not actually reducing. Over the next few weeks, it's very much possible that those tensions will actually come down as the fighting ebbs in Israel, Gaza. And the demand scenario for like oil products is pretty weak at this stage. So on a macro front, that's a positive. But see, from the Indian perspective, crude is not the same thing which it used to be 15 years back, that only crude determines our trade deficit or the inflation trajectory, etc. Overall, Indian inflation trajectory is much better place. And even if you look at the 10-year bond movements, it's very important. 2 years back, US 10-year was at 1.6%. Indian 10-year was 6.5%. Now, US 10-year is more near 5%. Indian 10-year is more near 7.4%. So our rise in interest rates also has been much more shallower, allowing the economy to adapt and the growth to sustain at higher levels.
Sandeep, what's your view on hospitals as the sector? I know you believe that Apollo Hospital sector was, expensive. Today, Morgan Stanley has initiated coverage with quite a bit of upside on that one. Any change in your view?
No, my view on hospitals was that it's a good long-term structural story, but we cannot be buying the stocks at all prices. Near term, some of the hospital results also which have come up show some stress on margins, etc. So we need to watch out for let the results, etc. come out, then we can evaluate. Structurally, it's a good story, but we have to buy at the right prices because we can't be buying at any price and at any valuation.
Hospitals and hospitality, two different sectors. But in terms of the price trend, hospital stocks have done well and hospitality stocks have also done rather well. And both the sectors got completely decimated post-COVID. Hospitality for obvious reasons, hospital for obvious reasons. I'm not getting there. But from the COVID lows, whether it is hospital or hospitality, rhyming. संदीप सरोवाल राइमिंग है तो हॉस्पिटल एंड हॉस्पिटैलिटी दोनों ऊपर है.
Yeah, both have done well and due to different reasons, and both took a beating during that time. And I believe today, as we look at it, hospitality overall as a sector has, I would think, is much more attractive than the hospital segment, given the fact that the trends are very positive. You yourself have been interviewing the Indian hotels CEO every quarter. I think what they've done with the company is phenomenal, and the kind of profits, cash flows they're generating, how their new brands are doing, how the asset light model is working. I believe that it is one stock which has now become sort of should be a core sort of holding in people who believe in the India story as well as believe in investing in mid-tier companies.
Okay. Tata Motors, and I'm going to spend some time with Sandeep, Nooresh and Vaishali to discuss Tata Motors. Sandeep, at the beginning of the year, your view was this could be the year for Tata Motors and the operating leverage benefits would kick in. Then they did a DVR buyback. Now they're taking a subsidiary public. But at 636, whatever good work they've done, do you think is it priced to perfection?
Nikunj, I don't think so, simply because of the fact that the improvements have been much more drastic than what people expected. It's like what happened on we were discussing hotels right now. It's like what happened there, where in one quarter, some Indian hotels, I think last year, delivered profits which analysts were expecting for the full year. And that's what operating leverage means. When things turn around, then the improvement in performance tends to be much better than what most analysts expect. I think the revision of EBIT guidance for JLR from 6 to 8% is very significant, and it indicates that the cash flow generation could be much more stronger. And if you look at it on a price-earning ratio, the stock is still near mid-teens PE ratio. It's not that it's gone up and it's trading at 25, 30, 40 times PE ratio. So I would think that stock still has the ability to do well.
Stock which we were discussing, and I think Sandeep owns it. I'm surprised why L&T is trading so cheap. Just think about it. I mean, they're doing a buyback. Capital allocation has improved. They've incubated on the same balance sheet the IT business. Their guidance is decent. ROAs have improved. 15-16% is the ROA now, right? And it is still trading at what, 24-25 times 1 year forward. So if you frankly ask me that, sometimes market gives you these obvious plays. It's just that we tend to always ignore them. We get blindfolded with a lot of new ideas without realizing that the best idea is actually right in front of you. कहते हैं ना हिंदी में चिराग तले अंधेरा.
Yeah, exactly. And in fact, Nikunj, look at how GCC, we were discussing this in the morning, right. Hydrocarbons have completely turned around for them. Almost 1/3 is coming from.
Yeah, and they're investing a lot in terms of like all infrastructure, not just hydrocarbons, right? From, making those stations to stadiums, everything is coming up, and L&T could be a big player. I know, Sandeep, you have been fairly positive on that stock. But let's say, what are the levels you're watching out for? What could be that stock price, let's say, a year from now on?
See, stock price prediction is very difficult, but I think the trends are positive. So in many stocks and sectors, you have to follow the trend, and as long as the valuations are not above your comfort level. So valuations of L&T are not above my comfort level because their delivery in terms of what they actually started to deliver in terms of top line, the possibility of improving margin profile as the older order book gets over, because typically it's a 36-40 month order book cycle. So I think that margins could improve next year. And the kind of orders they are getting from, and the larger size orders are so significant that it's very positive. Now, the reason many investors remain skeptical on such companies is because of lower return ratios as compared to some of the consumer companies, etc. But I think there also it will improve as they have become very wary of capex and not going into BOT projects, etc. So stocks done well in the recent past, and I would think that there's no reason why it won't do well over the next year. What returns it could give is difficult to say. I would think that whichever large cap stock offers 15% plus kind of return potential, I think that's something to look at.
Vaishali, what's the charts telling you right now? Around 3,300 it went and then scaled back to 2,800. Is there a trade to get in now in L&T?
Who are you asking? Me or
Vaishali.
Yes. So I would say Larsen is holding on very well in a worse scenario. I mean, we are seeing that market is showing signs of bottoming out, but yet I would say accumulate, because even in a worse scenario, I don't see the stock going below 2,700. And I think even right now it is at a make or break levels. So my view would be to accumulate, keeping in mind 2,700 acts as a prominent support, and projected target definitely comes to 32 to 3,300 as a positional buy.
Okay, so that's the take coming in from Vaishali on L&T. But the other heavyweight, Nooresh, Reliance and HDFC Bank, anything on the charts that are telling you that a breakout is imminent?
So these are the two charts that are actually becoming a problem in terms of the index movement. So if we look at Reliance Industries, the stock is at 2,300. That is where it was for the last 2 years, almost 2021, where it topped out, even adjusting for Jio. So out here, in the near term, it has been making lower tops and lower bottoms. But we've started seeing a recovery in the last 4-5 sessions from 2280 roughly to 2320 levels. The recent swing high is 2370. If it can cross, that would be the first indication of a trend change. So I would be watching it out if it can change above those 2370 mark. HDFC Bank, similarly, a similar swing high is much higher at 1550. The stock continues to struggle, and this ends up, both these names end up becoming almost 24% of the index. And that creates a no trend in the index as well. So for now, watching out whenever we see a price action beyond 2370 or 1540, 1550. That's the time would call a reversal, not as of now.
You know, I'm in this Friday mood, so Sandeep and Nooresh, please pardon me. I used to always make an effort to make Sandeep smile on television, but you've convinced for Sandeep to make, sometimes he smiles, now he's smiling. But Nooresh, I've failed to make you smile on TV. What can I say to make you smile? India jeet gaya, Sri Lanka haar gaya, Nifty upar hai. Nooresh, smile.
I think a stand-up comedy joke.
No, I don't know once actually, so I'm telling you. Let's smile. It's a Friday. India is... Did you see the match, by the way, yesterday?
Yes, it was fun.
You know, me and Anisha had gone there and we both, not planned, coincidence. Not planned coincidence. And we booked a dinner table for 9:30. The match got over at 8 o'clock. We reached the restaurant. They said, we are booking to 9:30 baje ka hai. Right, Anisha?
Oh, well, yes, it was too much fun. It looked like we were pretty much watching the highlights as well. But, you know, the vibe, you know, it's just a completely different feel. It was a long time after which I went for a match. But I think now, hopefully, we are there in the semi-finals. We hopefully have that first, level. And then the match is in Mumbai. So, let's see if we can do that. And then, hopefully, we'll get you also, Ajay, there.
What great form, Indian team is.
See, I'll tell you what I've realized. I mean, you know, the chorus there was Mohammad Shami. And Mohammad Shami has just been this real on this comeback trail. But guess what, guys? He's 35 plus. So, Nooresh, the best of yours is yet to come, Nooresh. Don't feel bad. I know you're aging, but don't worry. Shami's come back at 35. So, best of Nooresh and Merani is yet to come. Sandeep Sabharwal knows that best is yet to come. Right, Sandeep?
Yeah.
Age is never a barrier for you.
No, in the investing business, you count the reverse actually. So it's not like the player's life cycle. It's the investing life cycle actually the reverse. So best for many people are yet to come.
So I'm so glad everybody is enjoying the Friday spirit. And Nooresh, thank you, my friend. I've finally managed to make you smile today. We shall remember this day.
All right, thanks for your time today, Sandeep. But Techie, of course, stay with us. But there is reason to smile as far as Dr. Path Lab shareholders are concerned. Just looking at the way they have declared their numbers this quarter, very good internals as well. Let's take it forward with Bharat Upili Palan, who's joining us, CEO of Dr. Path Labs today. Bharat, thank you very much for your time. There's a very marked reversal as far as your numbers are concerned, internals are concerned, but volume growth was at 4%. So if we dissect your traditional, high volume, low value kind of business, and then the core business where volume may be lower, but the margins are high, how are the growth in both these segments?
Good morning, and thank you very much for having me on the show today. And I want to wish you, your family, and your viewers' families a very joyous and healthy festive season. I would like to deconstruct our quarter. To begin with, I would say we had a robust quarter across all metrics. Be it revenue, we had a record revenue of 601 crores. We had a good profit after tax. We had a strong volume growth, better than the previous quarter one. In fact, our volume growth for the quarter came in at about 5.2%, not 4%. And if you remove RT-PCR, which is a declining test and which is no more in vogue, then the volume growth actually moves up to 7.7% or so. So I think compared to quarter one, where we were almost flattish to, let's say, positive 1-2% on volume growth, we have seen a sharp uptick on the volume growth. But yes, we still have miles to go on that front. Our number of tests which we have conducted grew by 11%, and that is a very encouraging sign. So overall, all in all, I think we have moved all the matrices to be in a better position than where we were in quarter one. And more heartening was the suburban performance, which for the first time after, I think, 6 quarters, delivered a double-digit growth number. And we are very encouraged by suburban because West is a large white space market for us. And as this business takes shape, we would have kind of become truly, let us say, represented well across North, East, and West. We still have some way to go in South, on which work is going on. Now, coming to your question on routine test, high-end test, etc., I would like to point out that both ends of spectrum did really well for us this quarter. Our SwasthFit bundle portfolio registered a revenue of 125 crores, which roughly translates to about 500 crores run rate revenue for the full year. In fact, this is the number we envisioned about, let us say, 4 years back. I'm glad that we are kind of reaching there, and we're now setting up new milestones for the brand. The second thing I want to say is a super specialty portfolio continues to do really, really well on the top end of the medical excellence pyramid we have. And both these things driven well is really what is getting us to be in the position where we are in. The third important factor is, in the quarter's growth number revolves around the fever season. We had a small innovation going on in the fever season this year in the full scale. And it revolved around 2 factors. One is on the product side. We introduced a bundle test for fever diagnosis. So typically, people would have gone and done sequential testing for various kinds of fevers before they came to realize what kind of fever they had. We introduced Fever Panel Basic and Advanced, 2 versions of it. And that really got what people are really looking for and clinicians are looking for.
Sure. No, sure, Bharat, point taken. I just wanted to get more angles into the conversation as well, especially on the margin front. Your margin was at multi-quarter high, 29% thereabouts, but the guidance still remains around 25-26% band. Why is that? Are you expecting some sort of headwinds in the coming quarters?
Oh, no. So just to clarify, the quarter 2 margins are typically higher for us. We had a strong operating leverage because a hub lab program, which can do a lot more of testing than a small satellite lab, those kind of labs really did well. So I think what we saw was leverage coming through. As we look at Q2, Q3 and Q4, on a full year basis, we would like to come back to our, let us say, benchmark margin of 26% or so. That is about the right margin profile for the business. We also need to reinvest back the margins of the business, be it on marketing, upgrading our digital quotient, and on various fronts. So I think 25, 26% is a very comfortable range. It's a good range for us to have, and we'll continue to invest back in the business.
Will price hike be one of the levers for further expansion and margin? You've already taken one. Any more on the anvil?
So I think our results are getting misconstrued that all the gains have been on account of price increase. In fact, if you look at the volume, 7.7 versus a 14.4 non-RT-PCR growth, that means about 6.7% what is attributed to price. But honestly, if you cut that into two parts, 50% is price and 50% is mix. Now, mix is led by two factors, three factors rather. One is SwasthFit, second is super specialty portfolio, and third is a bundling we did around the season. So I think we have to understand that we have a very strong program going on mix management as well to be able to get a leverage on the bottom line while continuing to drive top line. On the price increase side, we are currently focused on driving the volume growth up, and all actions, all investments are towards volume growth. Price is not on the table. Price increase are not on the table right now.
What has been the impact of the corporate sector entering into the entire business, which is the diagnostic business? Now, whether it is Tata's or whether it is Reliance, they have sort of entered in your turf, and they are giving the same service, which is one pay one free, 50% discount.
So, Nikunj, I think, if you look at the history of this industry, at least I can speak for the last 7 years with a lot of confidence. Time and time again, it has been proven that frees and 1+1s really don't work. This is a business of medical trust where people really expect medical excellence to be able to take care of their health. Having said that, what we really have done in the past is to learn from our competition. Our SwasthFit bundle test program was inspired by one of our competitors. All our digital initiatives, which we have now taken to a new high, has all been, let us say, inspired by the digital ecosystem developing around us. So I'm sure as a resilient company with a lot of management bandwidth, money is being abundant, we will kind of put in place programs where we retain a number one position. Competition is welcome. Yes, indeed.
Competition is welcome. Thanks, Bharat, for making time and speaking with us. Appreciate you joining us. But it's time now to head back to our technical experts to get some insights into what the top mid-cap strategies could be at this point. And Nooresh, you go first.
So that would be a buy on NMDC. The stock has shown a relative strength all across the last few different time frames. The stock is not far away from a 52-week high. Yesterday also saw a good spurt up. Expecting a fresh 52-week higher, a target price of 175, stop loss at 155.
Vaishali, what about you? What mid-cap ideas today?
Actually, I had recommended Tata Motors, not a big cap, but I see it gap up opening. So now I would focus on Balrampur Chini. It's coming out of the trend. It's 429 right now. And my stop loss would be 413, looking for a target of 445 to 450.
Okay, Balrampur Chini, आपके मुंह में घी शक्कर. Your targets on Tata Motors already meeting, and that particular stock is actually on a tear. But let's also get you some more juicy mid caps which are being discussed in the dealing rooms, and my colleague Sharad gets you the cover on D Street. Sharad, what is the stock we are tracking today?
Well, in focus, we are having Man Industries, and the buzz is that the company is expected to receive a large order coming from a marquee client, and this order is expected to come in from the oil and gas segment. And the company itself is a small cap company having roughly 1400 odd crore market cap, and over the last 1 month itself, the stock has zoomed by almost 20%. Also looking at the numbers, especially coming from the industry sources and channel checks, it suggests that a strong demand is coming from two segments. Of course, the first one is the Middle Eastern segment, and the second is the oil and gas segment and the infra development around it. Also importantly, the Q2 numbers and the capital raising decision is going to happen next week on November 8th. Now, importantly, if you look at the Ratnamani Metals number also, which is also in the same space where it gives the pipes, they also came out with a very strong set of numbers. So in the entire oil and gas infra space would also be in focus.